Hi there, and welcome to number 3 in our legendary cash flow series. And the third part is how to model your cash flow. I've got Tyson, our business analyst, with us here today, and he's going to help us model a few different cash flow forecasts. Now, you will have already completed the first year cash flow forecast. You would have already mastered how to roll over your cash flow forecast, which you'll be doing every single week. Now, the next thing that we want you to learn is basically how to run different scenarios through your cash flow forecast. So today, we're going to do 3 different scenarios. Scenario number 1 is going to be a 25% increase in revenue. Scenario number 2 is going to be a 30% decrease in revenue. And scenario number 3 is going to be recruiting 1 team member. I've got Tyson here today to help me. And we're going to start with the 25% increase in revenue. So Tyson, over to you.
Yeah, sorry, Damien. Let me just bring up my screen.
Perfect.
Okay, we can see that.
Here's the example we've got prepared for you. So 25% increase in revenue. So let's start off, Tyson, here. Just go to the cash in.
Yep.
And we're going to go and add in the 25%. So yep. Tyson's going to do that for us.
Okay, so from revenue starting in this particular column here, we're going to add 25%. So basically pick up the column, put it in equals, and then 125%, which notates that it's going to be the 25% uplift. So equals 125%.
In this scenario, effectively what's happened is we've just won a new client. They're going to add 25% to our revenue base. And you'll also notice that Tyson is putting the first cash coming from this particular deal on the 7th of August. Because obviously we're going to have to complete the work and it's not going to hit our cash flow until the 7th of August. And he's gone and updated all the other amounts so that our cash flow is now showing plus 25%. So let's have a look at the summary, Tyson, see what that looks like.
Yep.
Whoa, look at that. Wow, that's a big jump up. We like the look of that. Now, it's not quite complete though. Let's go to the cash out. Because what we need to do is we now need to think, okay, so how are our costs going to change with a 25% increase in revenue? So the first thing that we're going to look at is obviously our cost of goods are going to lift, and our cost of goods will lift literally by the 25% that we're expecting in revenue, unless of course we can get some savings, but I'm going to just work on the plus 25%. So Tyson's going to just add our cost of goods and increase those by 25%.
Yep, so we times that by 125% just to bring in that 25% uplift. So I'll just quickly go on into this. And then obviously these are the values. So we're going to replace the upcoming ones just so they reflect these increased costs. Excellent. There we go.
Beautiful. So let's just go back to the summary, Tyson, just see what that looks like.
Yep.
Okay, so that sobers out the uplift a little bit. Now, let's just go back to the cash out, Tyson.
Mm-hmm.
It's worthwhile, we're not going to do this today with you guys, but it's worthwhile just having a think with a 25% uplift in sales, which is significant. What other costs might increase as a result of the sales going up? So you might want to have a little look, maybe some more petrol, maybe some more other expenses, but just have a little think and work it through and add in wherever you need to do it. But let's go back to the summary, Tyson.
Yep, there you go.
That is essentially what you need to do, and you need to just think through the implications of 25% more revenue equals more costs. And when people say cash flow it, this is exactly what we mean. Run it through a cash flow, run it through a model. Beautiful. Now, scenario number 2, Tyson. Something happens and 30% less revenue. So,
okay, let me just go ahead and open that one. Okay, can you see that on the screen for me? Do you have the 30% there?
No, that's good there. We got that up in front of us, Tyson. That's beautiful. Well done.
Thank you.
So first things first, let's go to the cash in. Yep. And we'll now go and take off 30%. So Tyson's just going to simply remove 30%. He's going to put his little calculation in here.
Yeah, so we basically just times the value in there for 70%, which is going to basically chop 30% off. So we'll go and update those values, which is here. And the final one in there, which is, yep, done.
Let's see what the summary looks like. Ooh, ouch. Not a pretty sight. Now, literally, guys, if you know, you are in a situation like this and you do nothing, well, that's where you end up. A very healthy cash flow looks pretty depressing quite fast. Now, we haven't done our work yet, though. Tyson, let's go to the cash out, please.
Yep, certainly.
So the first thing that we would do is we would go and reduce our cost of goods, because obviously we're delivering less service, less product. So we would need to take that down by 30%.
Yep. Okay, so same again, we're just selecting that. I'm going to times that by 70%. There we go. Like so. And then once we have those values, we just want to quickly copy and paste over these ones so we have the same values in the following months. Beautiful. There we go.
Now let's look at the summary.
Okay, there we go.
So you can see that's made a bit of a difference, but we need to do more. Now, clearly here, in a situation like this, you would be doing a little bit more than what we're going to be demonstrating here. But the bottom line is the biggest cost in almost every single business is the people. So Tyson, let's just go and look at the people, and let's just make this simple and just say that we're going to have to cut our wage bill by 30% to match the. Now it's a little bit more complicated than that, but I think this will illustrate the point nicely. So
yeah, sure. Okay, so if we're going to reduce that, we've got our weekly existing value was 11.5 grand. So same again, we're just going to grab that value equals times 70%, the reduction, and then obviously we're just going to drag and pull that across the spreadsheet so it updates all of the periods there. There you go, Danny.
Now, obviously, and Tyson and I had a little bit of a debate about this, obviously you would be needing to change the super, and you would needing to change the PAYG and all the other employment costs. But for the purposes of today's exercise, we're just wanting to be illustrative so you can see what happens. So, cash flow summary.
Yep, there we go.
Wow, look at that. There we go. So suddenly we've managed to change something that was looking pretty, you know, not pretty at all. And we've now made the necessary changes to our cash flow forecast. We've used it as a modeling tool. And look, now we've turned something that would look very, very unhealthy to something that returns to health. So, you know, excellent job, beautiful. Now, do remember that when you're doing this, you know, you do need to go through the line items and just have a look and see what happens. And you can literally go through line items and see what happens if I change this, what happens if I change that. And you can keep on playing with different versions so that you can see the impact of your decision making, which is really one of the major tools of cash flow forecasting is to help you make better business decisions by being informed. And you can literally see what happens if you do certain things. Beautiful. Now, Tyson, final one here. Let's go and do the the situation which a lot of people find, which is okay, I'm now looking at I'm growing.
Yep.
I'm going to add someone to my team.
Okay.
So let's open that final one.
Yep. You can see additional team member up the top there.
Beautiful. So we've now got the baseline again. Now, just before Tyson goes and does the changes, often people are sitting here and thinking, oh, can I afford it? Can I not afford it? I'm not sure. Should I be employing someone? And part of that decision is always money. So Tyson, let's just go and have a little look and let's go and see. So we're going to add in this scenario, and this is a $1.8 million turnover business, just to give you some idea. And we're going to add in a cost center, so operating expenditure, and we're going to add in a $60,000 some form of administrator is what we're going to illustrate. So Tyson's going to add that in for us now.
Yeah, sure. So when are we going to bring them in, Damien?
We're going to start recruiting now, so we'll go about a month's time.
Okay, so we'll bring him on basically in the week ending 3rd of July, I think. Excellent.
Beautiful.
Okay, so if we're bringing someone on at 60K, essentially what that's going to mean is, it's roughly speaking, it's going to add an extra $865 of net wages per week, which is obviously what you pay to the employer. So we're going to go ahead and increase that amount, and then at the same time, we're going to pull it across the forecast so it updates that period. Now, another effect of that is obviously it's going to increase our tax and superannuation. So what we might just quickly do, we'll just add an additional $500 a month to the superannuation, because that's essentially, strictly speaking, roughly what it's going to be. So we'll just quickly go and update that.
We negotiated this one. I allowed him a little bit of accountant precision here. And obviously, if you were going to be doing this properly, and we're just doing this for illustration purposes today, then you would be remembering to add to the PAYG and adding the total employment cost together. But today, we just, for interests of your time, we're just going to do that. So we're just going to add the super, but you would need to add the PAYG. So is that all done now, Tyson?
Yep, that's all updated.
Okay, so let's go and click back to the summary.
Yep, there we go.
Okay, well, so I don't know if you saw that very quick little ding, but adding that much from a cash flow perspective, as in adding that employee, you can pretty much see that it really doesn't make that much of a difference from a cash flow perspective. Now, every time you're thinking of employing someone else, you do need to be thinking about what is the cash flow implication going to be, and remembering that probably for the first 3 months, whatever you're hoping they're going to add to your business, it's going to take them about 3 months before they become productive and really start making an impact. So that's just another example of what you can use this absolutely critical business tool for, is modeling, putting new members on your team. Now, as always, for our clients, there is always the opportunity, if you've got any questions, got any comments, you're not quite sure what to do or how to do it, you've got to pick up the phone, and the team here, Tyson, is here to help. Stefan, Nikki, myself, and Sarah. That's what we're here to do, is to help you master this most magnificent of business tools. So, if you're one of our clients, by all means, get in touch, and we look forward to serving you even better. So thank you very much. That is the conclusion to this video, and this concludes part 3 of our how-to series, how to model your cash flow. Thanks very much, and see you next time. Bye.
Yeah.